Welcome to this Market Briefing Explainer. I'm James Gaverty, and today we've got a seriously fascinating and, frankly, incredibly timely setup to dig into. We're breaking down exactly why the current Chicago SRW wheat rally, which, let's be honest, looks incredibly strong on the surface, is actually a textbook bull trap. We're stripping away the noise, looking strictly at the data, the commercial positioning, and seasonal fundamentals to show you exactly why the smart money is heavily betting against the crowd right now. Let's get right into it.
Here is our roadmap for deconstructing the market today. 1. The bullish squeeze illusion. 2. Smart money is fleeing. 3. Peak harvest supply pressure. 4. The Williams counter-trend setup. And 5. The exact trade plan.
Starting with Section 1, the bullish squeeze illusion. Let's look at the trap that currently has amateur speculators panicking.
Okay, so we're seeing this massive divergence playing out right now. If you look at the public narrative, everyone is talking about this massive 11.9% price rally over the last 13 weeks, right? Speculators, the managed money guys, are caught in this huge short covering wave. They are literally scrambling to buy, which obviously adds immediate buying pressure and drives the price up. But the commercial reality? Well, the smart money is quietly and very aggressively doing the exact opposite. They're fading this entire rally and loading up on shorts.
Context is absolutely crucial here. Look at where this rally is actually happening. Price is trading right around 682.75. That means we're at 91% of the 52-week range, putting it well within striking distance of that 52-week high at 698.75. So the specs, they see price surging toward this high, they panic about a breakout, and they buy to cover. What they absolutely do not realize is they're just providing the exact liquidity the commercial institutions need to build a massive short position at premium prices. It's wild.
Moving on to Section 2, smart money is fleeing. Let's pull back the curtain and see what the big institutional players are really doing.
When you look at the latest CFTC data, the verdict is crystal clear. We've got an overwhelming 38% bearish reading on our counter-trend setup. Even with that strong price rally we just talked about, commercials are absolutely cratering their net position. They are happily absorbing all that desperate buying pressure from speculators and stepping in as the dominant sellers.
And what's truly staggering here is the sheer scale of it. They dumped over 35,000 net contracts, 35,260 to be exact, in a single week. To put that in perspective for you, that is one of the largest single-week deteriorations we have on record in this dataset. As the price surged 6.6% week over week, the smart money wasn't buying the breakout. No way. They were selling into it with tremendous aggression.
So, all this aggressive dumping pushed the 156-week COT index down to a deeply bearish level of 16. What's the takeaway there? Well, any index below 20 acts as a heavy, bearish contrarian anchor. It literally means commercials are at a 3-year net short extreme. They haven't been positioned this heavily for a decline in 36 months. Let that sink in.
That brings us to Section 3, peak harvest supply pressure. Let's see why the commercials are doing this.
These guys aren't shorting on a whim. They are the actual producers and users of the physical commodity, right? So let's look at the calendar. We are in July, which is historically the single most bearish month of the year for Chicago SRW wheat. Why? Because July and August mark the peak of the winter wheat harvest across the US and Europe. During this window, an immense amount of physical supply just floods the market. The commercial producers know this wave is coming, forcing them to hedge their physical crops aggressively in the futures market to lock in these high prices before that supply gluts the market and drives values into the dirt.
As you can see, this seasonal harvest pressure creates a clear, undeniable bear phase. A speculative short covering rally right into the teeth of the peak harvest. That is a classic seasonal trap. Managed money is buying into strength, sure, but commercials have literally every fundamental justification they need to absorb that buying with new shorts. This kind of setup very often leads to a secondary low in August right after the July harvest sell-off.
Which perfectly leads into Section 4, the Williams counter-trend setup.
When you combine that massive commercial shorting with a speculative price rally near absolute highs, you get a highly specific, highly lucrative technical setup. This is what we call a classic Williams counter-trend sell setup. The rules are simple but incredibly powerful. If the price is rising, and simultaneously the commercial smart money is aggressively adding short positions near a 52-week high, you look for a decline. It's a textbook scenario for fading a desperate, overextended rally. The smart money is literally flashing a neon sign telling you the rally is artificial.
And the data confirms this isn't just a flash in the pan. Notice the 26-week COT index here. It's sitting at 20.
This confirms that the commercial bearish posture has been steadily building for the medium term, even as the price has rallied. They haven't been guessing, they've been methodically scaling into this short position.
Finally, Section 5, the exact trade plan. This is where the rubber meets the road.
So we have the fundamental catalyst, the extreme institutional positioning, and the technical setup. How do we actually execute on this? You'll definitely want to screenshot these levels. We are looking to enter a short position right in this current pocket, between 682.75 and 690.00. Our first profit target, T1, is at 640.25. Our final extended target, T2, is down at 599.75. And to protect our capital, because you always have to protect your capital, we're placing a hard stop loss at 705.00.
Let me walk you through the logic here. We want to sell into any final speculative push toward that 690 to 698 resistance buffer. Target 1 at 640.25 represents a prior structural swing low and a gap fill from a few weeks back. Target 2, down at 599.75, takes us to key round number support at the late June lows. And that stop loss at 705.00, it's placed safely above the 52-week high of 698.75. This is critical, folks. If the price decisively breaks out above that high, it totally invalidates our commercial divergence thesis, and we want to be out of the trade immediately. No questions asked.
The data we've unpacked today paints a very, very clear picture. Fundamental harvest pressure is at its absolute peak, and commercial short positioning is at a 3-year extreme. The setup is pristine. So the only question left for your trading desk today is this. Will you follow the panicked, speculative crowd into a classic seasonal trap, or will you use the plan we just outlined and trade alongside the smart money? Thanks for joining me for this explainer, and I will see you in the markets.